Let's go to Jared Levy, UBS Senior VP of Wealth Manager Jim Lacamp, on these markets. Jim, end with you, begin with you. We're down about 100 points here. What would the markets do if there's an extended shutdown, not just one that lasts potentially a few days, but longer?
The markets hate uncertainty, Neil, more than anything else. So I think it would absolutely, given where we've come in the market, as high as it is, and with traders looking for any excuse to take profits, and I think this is what you saw 2 days ago, and I think this is what you're seeing today, I think it would be an issue for the markets. I think we'd get through that issue. We've had these issues before. We always do get through them. I don't think investors should try to trade in and out of this. The market looks pretty healthy here. The economy is doing very, very well. The news that we've seen out of Apple today is pretty representative of news we've seen across the board on these companies. Corporate earnings set to do very well. I think the market's going to be fine, but in answer to your question, in the very short run, it's going to be an issue for the markets if this extends. We hate uncertainty, right? But again, this has happened before.
You know, it has happened before to that point, Jared, and I'm wondering what you tell your clients and investors who see these enormous run-ups and, you know, maybe they use this as an excuse to take some profits or maybe not to get in at all. What do you think?
You know, first of all, you got to remember the emotions play a very large part, larger than most of us understand in the way that Wall Street works. In fact, behind all this big bad Wall Street is a bunch of sort of sensitive, cautious, and reactionary human beings, right?
Vulnerable. They are vulnerable human beings. You're exactly right.
They are. No, they are. And I think the reality is we've become a little desensitized to news, Neil. I mean, you know, look at some of the things that Trump says. You know, if you were to say those same things in an Obama administration or even a Bush administration, the market's reaction would have been a lot more volatile. I do think a government full-on shutdown would definitely draw down the markets, but I don't think that's going to happen. I think we'll avert it, and I think we continue to move higher here. You know, again, the emotions are running high, and everybody just about wants to be a bull.
You know, Jim, the one thing I will say about this, it doesn't matter whether you like Donald Trump or hate Donald Trump, whether you're a fan of the tax cuts or not. I think what has been underreported and unappreciated in this is just how over the top, big and generous these tax cuts were to companies. So big, so generous that whether it's the lower rate at 21% or the tax forgiveness rate, we're at one-time charge of 15.6%. They're trillions in the money, and they're sharing the loot with more than their shareholders. My point is that I don't think this was factored in to economic considerations or even market considerations, that for average folks, this could be a lot more dollars than was originally anticipated.
You're absolutely right, Neil. This has not been factored in enough. It's not been factored in enough on corporate earnings. You're seeing corporate earnings already respond. You left out a big part of the puzzle, and that is deregulation.
Oh, you're right. You're absolutely right.
The regulatory environment has been rolled back. So you look at business confidence now, and that's a real harbinger for jobs. Business confidence has been running high since the election. So businesses are doing well. They're very excited about the tax law changes. We've seen scores of companies, everybody from Apple to A to W, Apple to Walmart, that have given bonuses, given raises, brought money back overseas, which is what we were clamoring for in the first place. We think that it's underrepresented in the market. It's why the market's been making a big move, and that the market can go substantially higher here because earnings, which is really one of the main drivers of stocks in the first place, earnings are going to be better than people think because of the tax law changes and because of the improved regulatory environment. And let's not forget, we may have the first 3% GDP growth year in 11 years here. So the economy's doing pretty well.
Well, you know, Jared, I'm going to give you the concern argument here, and that is we've got a price earnings multiple on the market of about 27 to 1. That could change. We've got bullishness among Wall Streeters, maybe guys like yourself, at about 67%. I guess the highest since the start of 1987. We know what happened that year. And we've got this frenetic, some call it a melt-up atmosphere. Now, you can never catch this thing exactly right. But to those fears, what do you say?
I think there needs to be a balance. I think you need to be really careful in giving blanket statements. In other words, saying all stocks are overvalued or all stocks are undervalued. Apple's a good example because Apple a year ago said we're going to put $1 billion into the U.S. economy over 5 years. Just yesterday, they said that number is now $350 billion. We're not talking like
over
a 1 to 10. And the point Was it over 10 years? I'm sorry, corrected. But still, it's a large jump.
Which, by the way,
I'm
they
trying
don't
to
have
make
to
is,
deliver the goods on. It could be like me making a diet
they
resolution.
don't.
It's not worth on any.
But it's a good. That's a lot for PR. And Tim Cook is not one to overstate things. Here's the bottom line: a company like Apple sets the bar for a lot of smaller companies, and I think a lot of investors look at these smaller companies and say, "Oh, wow, if Apple's going to now contribute 350 billion, more than 300 times what it was going to contribute before, well, that's going to trickle everywhere." And that's not true, because tech is unique. Each sector is unique. You need to be really careful at just blanketly buying whatever stock is out there. One that maybe looks cheap. It's probably cheap for a reason, and it's probably likely to return or move lower, even as others move higher. So just be more selective, about your investment choices here.
All right, guys, thank you
Neil,
both.
I'd like to point out real quick, markets usually don't die of overvaluation. Markets usually don't die of old age. They usually die because a central bank gets over-aggressive and raises rates too fast. And so, we may go back and forth on this market. We haven't had a correction in a long time. A correction would probably be pretty healthy here. But I think what we really need to watch, instead of valuations, instead of even politics, is what the central bank does.
Yeah, you're right, because it's always something we didn't plan on or count on. Thank you guys very, very much.